Welcome to Digital Asset News, or Dan for short. My name is Rob, and today, just the thumbnail and title suggests, it's not all about the bearish sentiment. There's actually a lot of good things going on behind the scenes. So we're going to talk about what's going on with, looks like BlackRock, because they're trying to tokenize everything, and this leads me to the conclusion, or the question really is Polygon on board as it has with JP Morgan? Also, we'll take a look at the CFTC and the SEC regulations coming in hot, and then we're going to talk about public comments and how to do those things. Lastly, we'll also talk about the housing market signs are positive for the Fed. I'll tell you exactly what I mean. And then, of course, we'll do a little Q&A. I'll answer all your questions to the best of my ability. So we got a lot to go over, so let's just get into it. So the first things first is this, and that is I was going to cover this story. I don't know if you've heard of this story. FTX collapsed. I'm just kidding. Of course, everybody knows about this. And SPF, he was on CNBC, and he did a quick little interview. And it was just bonkers. And I was going to cover it. And he goes to talk about how he's sorry, which I don't really care how sorry you are if you lose everybody's money. Then he talked about how he believes that FTX US is still solvent. It's going to open up any day now. I don't know. But I was going to cover this, and I thought to myself, why? Why cover this? Is there anything we can do to change this about what's going on? Is there anything that we can do that will help us as investors? I mean, we understand that these things happen, or these things are happening behind the scenes, but what is it really doing for us? So I just thought to myself, again, deal with the things you can change and ignore the things that you can't change. We can't change what happened. We can't go back. We can't do anything with that. Hopefully, we follow the rules. We have below me, nothing on exchanges, and we move forward. So I'm just going to bypass this. I don't see why we do it. So what I want to talk about was some positive, which is this story, which just came out today. BlackRock CEO says the next generation of markets is tokenization. Now, this is Larry Fink. If you don't know this gentleman, he is in charge of BlackRock, which has, between 7 to 9 trillion assets under management. It's the largest asset manager on the planet right now. And of course, things fluctuate. But he actually gave a speech and talked about this. And I just wanted to bring it over his attention because these are the things that we can, not that we can change, but we can get into our psyche as far as investors go and go, wow, not everything is just awful. There are some things that are going on behind the scenes. Things are building, and the things that we would like to see as far as the big institutions coming in, well, they're coming in. And that's a positive, which I think we can all take to the bank, proverbially. So BlackRock CEO Larry Fink said the next generation for markets, the next generation for securities, will be tokenization of securities. And if you don't know, tokenization refers to a process where a digital representation of an asset is created on a blockchain, authenticating its transaction and ownership history. This approach enables a different way to trade assets like stocks, bonds, real estate, or even alternative assets like land, wine, or art, allowing the transfers to be visible on a public ledger. And someone brought this to my attention, especially like real estate. If you have to record anything in a public document, as far as like sales, when you go there and you go through the whole process and you're sitting there, there's a lot of middlemen, which increases the price astronomically, just for them to do nothing but just look at things and stamp it like you're a kindergartner. It's just crazy. So if we do something like this, and as far as just that part alone, just real estate, will save massive amounts of money. And then, of course, we get into stocks and things like that later. For some countries, it's not a big deal, but for other countries, they would like to have access to that. I think tokenization would be the big thing. He was speaking at a New York Times Deal Book event. Fink argued that tokenization will provide instantaneous settlement and reduced fees. And then he goes on for some other things. But it got me to thinking about, if we're going to talk about tokenization of assets and the things that he said, real estate, stocks, alternative assets, wine, art, all these different things, how much money is sloshing around? Now, you may remember this, as I've talked about this numerous times. This is all the world's money and markets in one visualization. Excuse me. And for each one of these squares is $100 billion. So the stock market, and mind you, this is in 2020, before the massive run-up. I haven't found an updated one yet. But it was $90 trillion around the stock markets. What if we could tokenize that? What if we could give that back to people who, if you're looking as far as like accredited investors or just different countries that are allowed to do these things, or just for different swaps and things like that, you could do a lot of crazy things with the stock market. Now, does that mean that you should, when they're offered, you should do it? That's not what I'm saying. I'm just saying there's a lot of money in stocks just for a tokenization of that. Money supply, of course, that's what Bitcoin and a couple of the cryptocurrencies do. They disrupt that. And money supply is about $100 trillion. What if you could tokenize debt, just global debt, households, governments, non-financials? I mean, you're looking at $253 trillion just in debt alone. And then what about, like I said, the real estate? What if you could tokenize that? What if instead of, and of course, there's these real estate investment trusts, which we're going to get to in a bit, which are collapsing. But what if you could tokenize your house in general? And you could say, okay, well, I don't want to sell it all the way, but we're going to tokenize it and go from there. And what about land? What about the things that are going? I mean, just in general, you're looking at 280 trillion. Again, this was back in 2020. Global wealth and derivatives, swaps, futures, and so on and so forth. So when Larry Fink talks about these things, and he's like, yeah, tokenization is the future, I'm thinking to myself, that is an amazing prospect, because that would be all the things we just talked about. What's our market cap right now? Oh yeah, we're like at $800 billion. We're less than 1 trillion. So if any of these things happen, I mean, that's pretty ginormous. And also, not to be outdone, because I was talking about Polygon, you're probably thinking, well, how does that fit into this story? In November, JP Morgan turned to Polygon to trade tokenized cash deposits, tokenized cash, in a Singapore-based trial via Onyx Digital Assets, which is a private blockchain created by the bank. I find this fascinating. They had a private blockchain, but they still needed Polygon to make things work, just to make things flow. So if you're trying to sit back and think to yourself, okay, I'm doing my own research, what should I get into? Maybe it's one of those things where you could say, well, maybe a layer 2 solution, maybe a layer 1 solution, because these things are coming on the pipe and they're coming in fast. So let me know what you think about that in the comment section. I find it quite bullish. And then also, actually, before I move on, this is another piece of good news I just want to throw in there real quick. And I want to say thanks to everybody. This is from a report from Bernstein. Crypto user activity is moving on-chain following FTX's collapse. It just talks about how more investors are storing crypto in their own wallets instead of with centralized exchanges, reflecting the higher trading volumes and user growth for DeFi. And I know when everything collapses, you know, we're looking at these things like, how could that happen? Why did this happen? I truly believe everything happens for a reason. And I think that these centralized players that collapsed, it allows us to start to move to self-custody, just like what everybody's doing right now, and learn the lessons now before things get massively overheated in the market. And the ones that, of course, you watching this video, you are the ones that'll be protected because you understand that I can self-custody it. I know how to do it. I learned my lessons from the Celsius, the Voyagers, and the FTX. And now moving forward, I don't have to deal with the rest of this stuff. So I just want to say thanks for everybody for listening as far as self-custody goes, because it really helps out tremendously. And then lastly, on this article, I just found it interesting. Solana, which was viewed as the native blockchain for the FTX Alameda ecosystem, is deteriorating the most. Users have moved to other chains following demise of SBF's empire, the report said. So if you're a Solana holder like myself, it's not like it's the worst thing ever. I mean, there's deals to be made. The question is, will Solana come back? I don't think the tech changed too much, but that's just what's happening. So let me know what your opinions are on that one. That'll be a good one. And now also, depending on how you see this, CFTC and the SEC regulation is going to come in fast and furious. It's just going to happen. And I'm going to show you about how we can change, deal with the things we can actually change. So with this one, it was an article. This is CFTC Chair Rostin Benham, and he's calling for the regulation in the wake of the FTX's collapse. It's amazing how pain will allow that to happen. And here we are. So he said it has to happen. Benham's remarks on Wednesday came at Princeton's new D Center. I don't know where that is. It's a blockchain-focused institute funded by crypto titans and Princeton alumni, the elites, including Joseph Lubin, Mike Novogratz, Peter Bridger, and Dan Moorhead, who were all in attendance. Sam was the scheduled keynote speaker, but that time slot was filled instead with a panel titled The Demise of FTX and Other Crypto Entities, Lessons Learned. Benham defended his commission's actions, or inactions, I guess we could say, citing limited resources and calling on lawmakers and policymakers to move as quickly as possible. And you better believe they will. It's just going to happen. Benham said that the only crypto, and this is the most interesting part of this, the article, because we know it's coming. But Benham said that the only crypto that should be viewed as a commodity is Bitcoin, walking back from previous remarks made in October when he suggested Ether may also be a commodity. Look, it's going to happen. Just let it happen. I mean, this is what's going to happen. Bitcoin's going to be a commodity. Everything else is going to be a security. They're going to come down hard. What does that mean? Does that mean the collapse of crypto? No, we talked about this numerous times. I don't want to go. If you want to hear my rationale, we'll wait to the Q&A. But this is just for you mentally to be ready, because this is what's going to happen. People are going to talk about how this is the worst thing of all time. I welcome it. It was going to happen anyhow. The question is, what are we going to do about it? And this would come down to the next article. Public comments. So CFTC commissioner wants a two-tier crypto rules for retail and millionaires. Hang on, it gets better. So the CFTC Commissioner Christy Goldsmith Romero said the current regime's definition of a retail investor is too broad, covering everything from average households to millionaires and hedge funds. The CFTC should have two categories of retail customers, that additional protections can be targeted to each group. Right there, it's looking pretty grim, because what that is the retail investor versus the accredited investor. And that's really what it comes down to. They want the rich people, the people with means, to be able to invest as much as they want to, because the people that don't have the means, you guys are, we'll say it. The people that don't have the means, they are the ones that are going to be left out in the cold, because they want to protect everybody. Is that right? It's not right. It's not how it should be. And there's no action to take. So to clarify, she was not seeking to cut off the average investor's access to the markets altogether, but would seek public input on what kind of extra protections should be afforded to these users. Initial ideas include easy to understand disclosures and limitations on leverage. Does anybody have a problem with that? Does anybody have a problem with that? Disclosures that come out and say, this is what we do. We're going to commingle your funds. We're going to make the loans. Do you understand? Yes or no? Just something simple, not a 500-page disclosure, which makes no sense in legal gobbledygook. Can we agree that makes sense? Sure. And then as far as like leverage, to not allow people who are retail investors to use leverage. Is that a problem for most people? Probably not. For some people, they like, hey, wait, I want to use 2x, 3x, 50x, 100x. There's a vast difference between 2x leverage, 3x leverage, and 100x leverage. Gotcha. Is that something you can deal with? The next thing goes down to this. Can you deal with the fact of someone coming in and saying, hey, you don't make $200,000 per year, or you don't have a net worth of $2 million or more. You are a retail investor and you can only invest so much. Do you have a problem with that? Probably. Well, make your voices heard. So how do you do that? Well, when she talks about public input, and I'll get to that in a second, actually. I just want to just throw this one thing in here real quick. Because to me, like on these two topics, easy to understand disclosures and limitation of leverage, that makes sense. To me, if you want to give input, it would be very easy just to say, hey, let people take a test just to see if they actually understand what the heck they're doing, and go from there. That makes sense. I mean, if you can understand some basic things like what's a commodity and what's leverage and what's a good structure for, I mean, just something basic, right? Just basic stuff. I think that would be a pretty good way to go. And then just say, okay, well, you know what you're doing. Let's go. But she was critical of the shift towards giving users direct access to the markets via trading apps, saying that a broker traditionally adds an extra layer of protection for the customer. She says, I caution against market structures that remove a broker's duties to retail customers without a full assessment of what will be lost. First of all, are we in 1982? I don't understand where this part's coming from. So what I need you to do, she's asking for public input, the CFTC. There's this website, cftc.gov, and it says how to submit a comment. And that's what they're looking at. And I was kind of shocked to take a look at, and before I go on, I linked in the description, you can find it, but to file a comment using the form, find the proposed rule and find the deadline and fill out what you want to say, click the comment button next to the item, enter the required information. Your comment and any attached to your pride will be published without removal of any personal information. And that's what they're going to look at. So what it looks like is this. It's going to take you to here. This is the website, releases with comments. I linked in the description. Looks just like this. There's a big fat thumbs up right next to it. You can go there and you can fill this out. And I would highly encourage you to do this. I'm going to do this myself once this order comes about. And I'll be updating you, so don't worry. But just so you know, when they talk about, and we've heard this before, right? Like, let's get some public comments. Do you want to know what the public comments are? This one was, the deadline was December 14th. The opening date was November 10th. Here's the comments. There's one comment, and it says, hey, 1-bedroom apartment, Port Neches, 2-bedroom apartment, Port Neches, 3-bedroom apartment. It's an ad. That's the comments that they're getting. Let me go back. I didn't look at this one. Let's see. This is back in October. There's 2 comments. It's from Andrew Robinson. The SEC and the CFTC are active in ongoing securities fraud. That's not, I mean, that's maybe true, but it's not very constructive. What's this one? I mean, you get my point, right? This one was open on October 21st, and December 20th it's going to come out. There's no comments. So like when they're saying, oh, we put it up for a public comment, they're expecting you not to do a thing. So once this comes out, we'll follow this. I'll let you know. And I want you to comment on this and go, look, I don't want you to limit me. If you're going to allow me to go into any casino and gamble my life savings away, you should at least allow me to invest in the things that I want to invest into, because I still think we're in America. Hopefully. And then go from there. So again, deal with the things you can change and ignore the things that you cannot change, and go from there. So know what you think about that. And then also, as far as regulation goes, that's pretty interesting. SEC. SEC is going to use not only FTX, but BlockFi as the object lesson for clear crypto regulation. So just so you know, BlockFi, they just went through, they just went through Chapter 11, or just submitted Chapter 11 paperwork 3 days ago. Then 2 days ago, they came out and they said, hey, here's our reorganization plan. I got to tell you, very nice. Good for them. They must have known, obviously, right? Celsius, 5 months later, no plan. But BlockFi is going through their Chapter 11, and they still owe the SEC $30 million of a $50 million fine. I just thought that was interesting. The SEC won't be as aggressive about getting their money back as it would from others. And the message from the SEC they will want to send, has been trying to send, is less about the sanctity of SEC settlements and how we go about regulating a very young industry. This is from, this is according to Howard Fisher, a former SEC senior trial attorney who is now a partner at Moses Singer LLP. This is what he talks about. He said the failure of the FTX crypto exchange brought to light the need for crypto companies to use the same metrics and management techniques used by traditional and legal financial companies. According to Fisher, the SEC isn't hostile towards the digital asset industry, but it's skeptical of its inner workings. I got to tell you, I'm the same exact way. I'm very skeptical of what's going on behind the scenes of all these different exchanges. The SEC is going to be a lot more concerned, not with the money from the settlement, but from what the BlockFi bankruptcy represents in terms of harm to investors, systemic risks, contagion, and what it shows about the risk to crypto worlds in general. So I personally believe that we can't move forward until we get some kind of clarity. And that's just how I've always been, and that's just how I see it. Correct me where I'm wrong. And do you think that we can just get by with zero regulation moving forward, especially with all the collapse that are going down? Just a question. Then also, when we talk about contagion, I know people were pretty excited yesterday because Jerome Powell came out and he wasn't as super hawkish as he's been before. And he did say some dovish comments, like he's going to slow down for the rate hikes. He still says we're going to keep doing them until they hit a 2% threshold for inflation. But people were pretty jazzed about that, and the market responded. It looked pretty good. Now it's kind of evened out. But to me, when we talk about these things, I still think in the long run, just like we talked about with Larry Fink, with regulations coming, I think we're in a pretty good spot in time. However, I think in the near term, it's going to suck for a bit. And one of those things is this contagion. And I don't know how far it goes, but this is a nice little graph. There's SBF. Of FTX, Alameda Research, FTX US, and FTX Ventures. Just remember that they've touched a lot of different projects, and who knows how many are going to go down. But everything from Consensus, Illumia, Lido, Masari, Polygon, Refinance, Solana, WonderFi. Well, WonderFi is looking to do pretty good, actually. Blockfolio, LedgerX, not to be confused with the cold storage device. LedgerX is I think it's some kind of exchange. Don't really use it. Liquid Global, Ledger Prime, BlockFi, Aptos, Chill Chat. I don't know what that is. Layer Zero Labs, Masari, Paragraph, Skybridge Capital, Yuga Labs. So there's a lot of different tentacles and a lot of different things. And I don't think when Three Arrows Capital went down and then Celsius crumbled and then Voyager collapsed. And now we have FTX. And then, of course, now we're going to, of course, BlockFi is already down. The next domino to fall, I'm not for sure, but I see there's some problems on the horizon. And that also leads me to my last point, housing market. So Blackstone, I think it's got a couple trillion assets under management. Correct me, I might be wrong on that one. But this just came out today. A $69 billion real estate fund hits the redemption limit. What's happening here is Blackstone Inc.'s $69 billion real estate fund for wealthy individuals said it will limit redemption requests. People are like, give me my money. We need to pay some things off. And I think there's the contagion. This is one of the most dramatic signs of a pullback as a top profit driver from the firm and a chilling indicator for the property industry. And this is what, honestly, this is what the Federal Reserve wants. They want max pain. They want things to go down. They want unemployment to go up. And that's just how it goes. The fund became a behemoth in the real estate industry since its start in 2017. They bought up apartments, suburban homes, dorms, and growing rapidly in an era of ultra-low interest rates as investors chased yield. Now, soaring borrowing costs and a cooling economy are rapidly changing the landscape for the fund, causing this real estate investment trust to caution that it could limit or suspend repurchase requests going forward. And also, this is from Liz Saunders. Who's she? Chief Investment Strategist Charles Schwab. And she said, hey, pending home sales now down by nearly 37% year over year, which is the worst annual decline on record going back to 2002. On top of that, Jeffrey Cleantop, also part of Charles Schwab, says the U.S. is not alone. It's not just based here. Housing affordability has driven sales down sharply from the recent peak in many countries. Unfortunately, these real estate investment trusts now have a lot of things on their balance sheet. Let's hope it works out for them. But again, everything's connected. And that is it. So, my friends, that takes care of the news today. If you like today's video, I know there was a little bit of a bullish sentiment, but also bearish at the end. I'll try to give you a little bit of balance. Thumbs up. Always consider subscribing. Now, if you want to stick around, we'll do Q&A, and this is my favorite part of the show. I'll answer all your burning questions to the best of my abilities, but that is it for today. If you got to take off, take off. It's been 23 minutes, but thanks for stopping. Now let's get into the Q&A from there. I can't see too much. Okay. Tyler Durden. There's a reason I've been renting the cheap of town for the last few years. Very smart. I got to tell you, people who are renting, well, first of all, I think the rents will probably go up. But